President Obama's former top economist says the current debate over monetary policy is missing the mark. In the New York Times this weekend, Christina Romer wrote that monetary policymakers are all hawks now. Even those who most emphasize the Fed's role in fighting unemployment oppose policies that would raise inflation above the Fed's implicit target of about 2%. She says the real division is between those following theory and those following evidence, and it could have a big impact on what happens next when it comes to inflation. Joining us right now to talk about this is Bloomberg contributing editor Christina Romer. She's the president's Council of Economic Advisors until late last year. She has since returned to her position as an economics professor at UCLA Berkeley. Great to have you here, Dr. Romer. Talk to us a little bit about the debate that you see really going on with the Fed, because as you know, we always talk about the hawks versus the doves. You say, though, it's really the empiricists and the theorists. Talk to us about that.
Absolutely. So on the hawks and doves, I think the point I was trying to make is that everybody cares about inflation these days. Even the members of the Federal Reserve who are, the most concerned about unemployment would not favor a policy that was genuinely inflationary. Where I think the big division is coming is over what people think causes inflation. And so the people that I describe as empiricists tend to look back at the evidence and say, typically inflation, when unemployment is high, when it's above normal, typically inflation doesn't pick up. So I think those kind of believers tend to not be very worried about inflation in the current environment. The alternative are the theorists, who I think put a lot of weight on credibility, who worry that if the Fed takes any action that might cause their credibility to come into question as inflation fighters, you might see inflationary expectations jump up immediately, and that could then show up in actual inflation very quickly.
And also,
so I describe it as the fight between sort of people who think that inflation is unlikely now versus those who think it could bite us at any minute.
Also with us is Bloomberg economics editor McKee. And Mike, I'm guessing you might want to jump in here.
Yeah. Well, I want to ask you, Dr. Romer, because I've talked to a number of the Fed officials who would fall into the theorist camp, and their view is it's not just theory. They look back on history and they see episodes where inflation did break out much more quickly than the Fed thought, and historically the Fed has come in behind the curve on inflation, and they say it's better to be prepared to act before you see the whites of inflation's eyes.
Oh, I mean, I have no question that, of course, the Fed has to be forward-looking. And so there certainly have been times when the Fed was caught unawares. But it wasn't because inflationary expectations jumped out of nowhere. It's because, say, in the 1970s, the Fed had a flawed estimate of what they thought normal unemployment was. And so they thought there wasn't any inflationary pressure when, in fact, there was. And so, of course, the Fed has to be forward-looking. But the question is, if you're forward-looking, what should you be expecting now? And if you look, for example, at survey evidence from the Survey of Professional Forecasters, we don't see inflationary expectations jumping up as the theorists are worried about. And so I think, yeah, go ahead.
I was going to say Bill Dudley today, who is definitely in your empiricist camp, said that they don't necessarily know where full employment is today. And there's also some question about whether we really know what the output gap is, whether we know what the economy's actual speed is.
Oh, I agree. There's a lot of uncertainty about where full employment is. I think virtually no one thinks that it's at 9%, that, there is a raging debate among the economic community about whether the normal rate of unemployment has jumped a percent or maybe even 2 percentage points. But the idea that at 9% unemployment we're at normal, I think, is pretty silly. And so even if we don't know how big the output gap, I think we could be pretty confident that there is a gap, that we're still, below trend or above full employment. And so that's naturally going to be putting downward pressure on inflation.
Dr. Romer, you talk about, signs of inflation. What about the move up that we're seeing in commodities? We talk about it every day, about the moves that we're seeing in various grains and certainly the energy market, oil market. We know that there's a lot of it has to do with the concerns in the Middle East. But if you talk about the longer trends, everyone sees things, for the most part, moving higher here. Shouldn't the Fed start to notice that and start to be proactive here?
So, of course, the Fed is watching commodity prices, and as you mentioned, they are certainly going up because of some, idiosyncratic factors like trouble in the Middle East, or because some parts of the world are growing very quickly, such as China and some of the other emerging markets. But of course, what the Fed has to keep its eye on is what's inflation, what are those longer term trends in inflation? And commodity price movements, we know, tend to come and go. And so if you're interested in what are the underlying inflationary pressures, measures like core inflation, which are still very low, are what you tend to look at. They're a better predictor of future inflation. So absolutely the Fed is watching commodity prices, but it also has to keep its eye on core inflation. And, we just got numbers today on the core personal consumer expenditures numbers, price index. And that was still coming in at 0.8%.
So is this why you argue, because you write this in the article, the Fed could engage in much more aggressive quantitative easing both in size and in scope to further lower long-term interest rates and the value of the dollar? Are you saying that the Fed should be even more aggressive, that we should definitely have a QE3? We've got about 40 seconds here.
I do think we should be thinking that way. I find it very worrisome that all of the talk recently is maybe we should be dialing back on QE2. And I think if you look at the overall state of the economy, it is still a very troubled economy. I think the hope of any more fiscal help is very small. In fact, we're likely to go to fiscal contraction. So the Fed should be thinking about what can we responsibly do to help this economy heal more quickly.
All right. So much more we could talk about. Christina, we'll have to get you back here another time. Dr. Romer, thank you so much. We appreciate it. And, of course, our thanks to our own Michael McKee.